So welcome to this video. In this video, we are going to discuss about the basic concepts that are required to solve a lengthy problem in your exam. So here we learn about inflation concepts in NPV. So there are like two concepts here. One is called as a real return and the other one is called as nominal return. So it is expressed in this formula 1 plus I equals to 1 plus R into 1 plus H, where the I refers to the nominal rate or money rate, R refers to the real rate, and H refers to the inflation rate. So we can put it like this. The money rate or nominal rate, okay, is a combination of two things. So one is the real rate, which is an uninflated rate, and you multiply this with the inflation, okay, you get the inflated or nominal or money rate. Okay, so that is how these three elements are interrelated. If there are several inflation rates, use the general inflation rate to compute nominal factor. So assume a problem tells you like there's a wage inflation, materials inflation, and general inflation. The general inflation number is what you have to use for this inflation. Okay, so that is how it works. Also, there's an important note here. Note, values stated as T0 or current or today's value represent uninflated or real cash flow, and the words nominal or money or inflated cash flow all mean the same element. So that is about the notes and the important concepts here. So we'll move on to work out the discount factor. So here we are going to find out the real discount factor from the question given. So we'll start. $1,000 is invested in an account that pays 10% interest per annum. Inflation is currently 6% per annum. Find the real return on the investment. So as he says to find out the real return, okay, the missing number is the real return. So the number which are like given are, this is the nominal return, this is the money return or nominal return number, and this is the inflation given. So what we'll do, we'll try to find out the R. So it is 1 plus I equals to 1 plus R into 1 plus H, where the nominal return is 10%. So 1 plus 10%, 1 plus R, we have to find out the R, into 1 plus H. H refers to the inflation rate. So we'll take the 1.06 to the other side. So we'll try to find out the answer. The number comes to 1.0377 equals to 1 plus R. We will take the 1 that side, so that will become minus 1. 0.0377 is the R. So we can either take this as R or 0.0377 into 100. That will be equaling 3.77 percentage. So normally the real return will always be lower than the nominal return. So if you see here, the nominal return is 10%, but the real return will be lower. So that is why it is at 3.77%. So we can also put it like this. The real return will be less than the nominal return. Okay. So that is how they are linked. We'll go to the next problem. So in this problem, I think we are going to find out the nominal discount factor. If the real rate of return is 9% and the rate of inflation is 5%, what should be the money rate of interest will be? So we have to find out the nominal interest. So we'll have the formula 1 plus I equals to 1 plus R into 1 plus H, where we have to find out the 1 plus I. So 1 plus R is 9% and H is 5%. So the number will be, so to solve it, I think we'll have the I this side. The 1 will move on to the other side. So the I would be 0.1445, or it can also be multiplied by 100. So that comes to 14.55%. Okay, so that's about the money discount factor or nominal discount factor. So again, if you see, the real rate will be less than the nominal. So the nominal is always higher than the real rate. We'll move on to the next problem. So we'll see the relationship between the real and nominal discount factor and cash flows. So you can solve a problem like this. If you have real cash flow and real discount factor, you can directly get the NPV. If you have nominal cash flow and nominal discount factor, you can get NPV directly. If you have a real cash flow and nominal discount factor, then what you have to do is you can either inflate the real cash flow and then you will arrive at the nominal cash flow. So you already have the nominal discount factor. You have now computed nominal cash flow. With both these, you can now compute the NPV. Or there's another way. You can find out the real discount factor because you have the real cash flow. You can find out the real discount factor using the previous approach we did with this formula. Once you have got the real discount factor, then what you can do is, you know the real cash flow, it is here, you know the real discount factor you found out here, and you can then compute the NPV. So that is about how the real and nominal cash flow and discount factors are related. So if nominal cash flow and real discount factor is given, then what you can do is you can find out the nominal discount factor because that is the easiest approach using the formula which we did earlier. And now you will get the nominal discount factor. You would have got the nominal discount factor by this formula. So when you know the nominal cash flow and you know the nominal discount factor, you just found out it, then you can do the NPV. So however you do it, you have to get it in a common terms. Both should be in real terms or both should be in nominal terms. Then only you will get the right answer. So we'll start with the question. Discounting money cash flows and real cash flows, ABC Co is evaluating project Z, which requires an initial investment of 1 lakh. Expected net cash flows are 25,000 per annum for 4 years at today's price. So if it's today's price means it is the 0th year price, it's a 0th year price, or in simple terms, it is a real cash flow. It's a real cash flow number. Cash inflows are expected to rise by 5.5% because of inflation. So inflation is given separately. The money cost of capital, that is the nominal cost of capital, is 15%. They want us to calculate NPV by discounting the money cash flows and discounting through real cash flows. So we'll start from the first part, nominal cash flow and nominal discount factor. So we'll use this approach to solve it. So if you look here, do we have the normal cash flow? The answer is no. What we have here is the real cash flow. So how we'll get the normal cash flow? We have to inflate all these numbers. Then we'll get the nominal cash flow. Do we have the nominal discount factor? Yes, it is available here at 15%. So this is available. First, our job is to get the nominal cash flows. So how we'll get it? We'll work out a NPV. We'll start from nominal cash flow. To solve this, we'll do it thousands. So we'll start. See, the 25,000 which is being stated here is on the first date of the year. But if you put the number 25 here, that doesn't work because 1 represents the end of the year. By the end of the year, the inflation would have occurred. So what we have to do is we have to inflate the 25,000 here. So how we'll inflate? We'll inflate it by the inflation rate, which is 5.5%. Okay. So first we'll do that. So we get 26.37. So again we have to add another 5.5% for the second year, 27.82. So again we have to add 25%, 5.5%. We get 29.35. So again we have to add 29.35 plus 5.5%, 31. Okay, so once we have got the nominal cash flow, then we have to get the investment. So the investment is 1 lakh. So we'll cut 3 zeros, so that will be just 100. And now we'll have the discount factor. The discount factor would be the nominal discount factor, which is already given there. So that is 15%. So for 15% we'll do 1. We got the discount factors. Now our job is to multiply. So we got the present value. We'll add all of them. Minus 19. So our NPV is a negative 19. So what we'll do is we'll also try the same problem with discounting the real cash flow. So we'll start with discounting the real cash flow. So the real cash flow in this problem will be the same 25 for all the years, and the investment will be 100. We'll do the sum with 3 zeros or cut in thousands. So this is the format. So then we can get the discount factor at this percentage we have to find out. So then we'll get the present value, then we'll get the net present value. But in order to do this, we need to find out what is the real rate. Okay, so the real rate we will work out here. So if you take, the formula is 1 plus 1 plus I equals to 1 plus R into 1 plus H. So we have to find out what is the R. So I is 1.15, so that is the nominal rate. 1 plus R we have to find out, and 1 plus H is 1.055. So the R actually, when you solve this, comes to 9% or 0.09. So we can take the discount factor as 9, and then we can get the answer. So when you add all this number, the NPV again comes to a negative 19. So what is the concept here? So either you use the real nominal cash flow with the nominal discount factor, or you use the real cash flow and real discount factor, you'll end up with the same answer. So that's what this problem tells you. We'll move on to the next problem. Here we'll be like looking at the NPV and tax benefit. So a company can avail tax benefit for the depreciation they are like eligible. So this is a format. So take the years on this side, and you then have the opening value of machine, direct depreciation, you will get the closing value of machine, multiply this depreciation with the tax rate, you will get the tax benefit. So in the last year of sale of the machine, for that alone we have to do a different approach. Okay, so that we will explain in the next problem. So we have a problem here, we will try to do this one. An asset is bought for 10,000 and will be used on a project for 4 years, after which it will be disposed of. Tax payable is 30%, but it is payable in 1 year in arrear. Capital allowances are available at 25% reducing balance method. Calculate the WDA. So WDA is the depreciation and the tax savings for each year if the proceeds on the disposal of the assets are 2,500. So we'll work out this problem here. So we'll start from as per the format. You start with the particulars, then you have year 1. So how many years the machine is being used? The machine is being used for 4 years. So 1, 2, 3, 4. We'll also have a fifth year. We'll have a fifth year, and we'll work out the opening asset value. So opening value of the asset we have to work out. Then we'll work out the depreciation part. Okay, so the depreciation is at 25% of the opening value. Then we'll get the closing value, and we'll also get the tax benefit. So the tax benefit is at 30%. So that has been given in the problem. So we'll start to work out. So the opening value of the machine is 10,000. We have a depreciation at 25% of the opening value. So that comes to 2,500, which is a negative one. So the closing value is 7,500. So again, for the next year, the opening value is 7,500. So what will be the depreciation? 1875. We will deduct this number from the opening number. 5625 becomes the opening number. We'll find out the depreciation for this, 1,406. If you take the last year we have the opening value, but we don't have the closing value because the assets are sold, right? The assets are sold. So whatever asset has been sold, take that amount as the closing amount. Okay, if you want, you can mark it as asset is sold. Okay, what is the difference between the two? So the difference between the two is 1,718. So this is a balancing figure. Okay, and this represents the loss on sale of asset. Okay, so this is a loss on asset. So this loss on asset is also similar to depreciation. So what we can do is now we can compute the tax benefit. So the tax benefit becomes 750, 562.5 here, but for the last year it becomes 515.4. So we compute the depreciation and then we compute the tax benefit. But if you see, the depreciation can be a negative number, okay, but the tax benefit is a positive number because it is a cash inflow or a tax benefit. So that is a very important concept here. And also this 750 is not going to be received on the first year because as the tax is payable in arrear of 1 year, so this tax benefit is received on not on the first year but in the second year. This is on the third year, this is on the fourth year, and this is on the fifth year. We'll move on to the next problem. If the asset is sold for 5,000, how will our answer change? So we'll look at the same numbers, but we'll change the color now and we'll try to do it. So this is not 2,500. If it's like 5,000, what would happen? So we'll work it out. So if the asset is sold for 5,000, you can see that the asset has been sold on a profit. It's not a loss, it is a profit on the sale of asset. So the balance difference 728. If you see, that is a profit for the company, but from the tax angle the company cannot claim benefit as they have earned a profit. That becomes a payable tax. They have to pay tax. So how much they have to pay? They have to pay 30% on this, and this would become 234.6. so if you look here, this 234.6 has to be paid, so it's a cash outflow. That's why we have a negative symbol here, and this will be paid on the fifth year. So this is the difference between when an asset is sold at a loss and if it is sold at a profit. So here we will see the relationship between NPV and working capital. So there are actually like two situations. So we'll start with the first situation. If working capital is not going to be released at the end of the project or life of machine, or the machine is going to be replaced by another machine, then how would we solve it? That is, the working capital is not released. So this is the format. Have the years on the top. Working capital invested is always a cash outflow. So the cash is never released. So this problem, we are working out this to understand how the NPV and the working capital are like related. So we'll start here. So a company expects sales for a new project to be 2,25,000 in the first year, growing at 5% per annum. The project is expected to last for 4 years. Working capital equals to 10% of annual sales is required and needs to be in place at the start of each year. Calculate the working capital flows for incorporation into the NPV calculation. So there are like two scenarios in which the working capital problem can come in. So we'll start from the first scenario. If the project is expected to continue after 4 years with the new machine, so the working capital is invested for 4 years. Thereafter, the working capital is still going to be used by the new machine. That is, the working capital is not going to be released. In that case, how should we do it? So first, we'll start. See, the expected sales is going to be 2,25,000. So that is the sales in the first year. So we'll take that number, 2,25,000. So that's going to grow in terms of 5% every year. So we'll take it as 1.05. So we got that number. We can just pull it. So these are the growth in the sales, and they say that the project is expected to last for 4 years. Working capital equal to 10% of annual sale is required and needs to be in place at the start of each year. So this first year is the end of the year. The beginning of the first year is actually the 0. So we need 10% of sales of the sales, okay, at the start of each year. So we can just drag it for the next 3 years. So this is the working capital which is required. If you look at it, working capital is something like a reserve. So every time you are going to add an amount, okay, it only gets added. It's something like a top up, okay. So every year you top up little by little and it keeps growing. So what happens is we have to find out how much of working capital has to be invested. So we'll start from there. So working capital, initially it was 0, then we have invested 20, then we have invested this number. So at the start of the year we should have 22,500. Okay, why it is a negative number? Because it is a cash outflow. It's a cash outflow number, so we are having it as a negative number. So the first year number you have calculated. From the second year onwards, we'll work it out like this. So from the second year onwards, there is already an existing capital of this number. Okay, from there we have to increase it to this number. So 22,500 of working capital is already there. We have to increase it to 23,625. So only the difference is what we have to implement in the working capital. So we just have to take these numbers. So that's about it. So when you add all these numbers, you will get this last year working capital number. So we'll just try it whether it comes. As all the numbers are negative numbers, so you can see here. So when you add all these investment in working capital, okay, even though you do it bulk in the 0th year, then little by little you do it, okay, cumulatively it comes to 26,046, okay, and that was the working capital required in the third year also. So this is how you have to calculate the working capital. So this number could directly be like taken to the NPV table. So ensure that you understand this. So we'll move on to the next method. The next method is if project is not expected to continue beyond 4 years. So that is, the machine is going to be sold and we are going to close the project, then the working capital will be released. So that's our assumption here. So if that is going to be the assumption, okay, the first two rows are going to be the same. There will be no change, but the only change will be this, that is the working capital required in each year will be released in the last year. So how much would be released? The release will be this amount. Okay, so we can even copy the last statement also, that won't be any problem. So we got that. So in the last year, whatever we have invested will get released. So we can put it like this. So it can be a sum, all these numbers which have been invested, they get released. If they get released, it should be a positive number because it's a cash inflow. So if I sum it, it comes to a cash outflow. Okay, so we'll put like this. All these numbers from here to here are cash outflow. Okay, the same logic applies here also. All these numbers from here to here are cash outflow, but these are cash outflow, but the last number is not a cash outflow, it is a cash inflow. So as it is a cash inflow, we can't put it a negative symbol here, because this line we will copy it from here and we'll paste it in the NPV table. So what we can do is we can change the formula a little bit. So how we'll change it? We can multiply it by a -1 so that it becomes a positive number. So this is a cash inflow. Okay, so we'll mark it like this, and we'll have a color. Okay, so that's how it works. So in the first scenario, the assumption is the working capital is going to be continued even after the fourth year, so the project is not going to end. In the second case, the project is going to end with the 4 year, so whatever investment that we have done is going to be released in the last year. So that's how this formula works. If you want, we will put the formula itself separately here. Okay, so that's about the problem. We come to the end of the chapter. Thank you very much for watching. We'll meet in the next video.